I asked AI to build me a $5 million investment portfolio. As somebody that advises high net worth investors every day, I was pretty surprised with the output. So if you want to build your own portfolio built to maximize wealth, tax efficiency, and the odds of success, I'll show you exactly what works with this portfolio and what changes I would make so you can go step by step and implement this yourself. Now, most people assume a $5 million portfolio should look totally different than a $100,000 portfolio. But in the real world, most advisors will spit out basically the same portfolio for that $5 million that they would for $100,000. Why? Because they are trained to sell what works best for their firm. They are not trained to implement specific portfolio investment strategies for wealth at that level. So in this video, I'm going to walk through the 5 things that I would do differently. And we're going to build a $5 million portfolio step by step. And hopefully it's going to increase your odds of success. By the way, I'm Brad Johnson. I've been investing in private markets for 20 years. I help high net worth clients structure these exact type of portfolios. And so let's dive in. All right, so let's figure out what AI would recommend for a hypothetical client here, a 55-year-old man. He's got 2 teenage kids, a wife. He owns a business. He's a very busy guy. He recently sold his business for $5 million. That's going to be the amount of money, the nest egg that he wants to invest for retirement. That's the amount of money we're going to focus on. He has a monthly need of $20,000, $20K a year for their lifestyle, and he plans to retire at age 60. So he'll start needing that money in year 5 from today, right? So he has the ability to invest some dollars and start doing a little bit of compounding before he starts touching the portfolio. All right, so that's our hypothetical situation. What does AI recommend? Okay, AI understood the problem here, right? It's not a wealth problem. He's got $5 million. It's a healthy chunk of change. It's more of a income problem. Is that amount of income per year going to be feasible? And so the key is to not run out of money. So this is a sequence of returns problems, which is a fancy way of saying do not have early negative years where you're selling a lot of stock out of your portfolio when the market is down, because then you get negative compounding. And so you're bleeding down your principal over time. Right, so that's what AI is saying here. Avoid large drawdowns in those early years right after retirement. And then this is a subtle point that most people don't always get, is that you need to maintain your purchasing power. You need to outpace inflation. And of course, you're going to have other needs that they're going to pay for, which we've included in that $240,000 total yearly number that he needs starting at age 60 for his family. All right, so AI is recommending that he has 50% of his portfolio into equities, and that's made up of 30% U.S. total market index, presumably the S&P 500 or maybe a Dow index, 15% in international developed markets, right, to diversify worldwide, and 5% in emerging. Fine. These are in low-cost ETFs. That makes sense. And avoid concentration in any one individual stock. I mean, this is all fairly sound. It's expecting 6 to 7% nominal. That feels a little light, but I think that's influenced by where valuations are today, what some of the Wall Street firms are projecting for the next 10 to 15 years. But historically, it's closer to 9%, even 10 if it's just domestic. So I don't necessarily think that's accurate, but let's move on. So 35% of the portfolio would go into fixed income. So that's bonds, right? Stable income. This is the risk-free rate. This is widely considered to be the safest investment in the world. U.S. Treasuries. I might disagree, but that's okay. Let's dig in here. The makeup of that would be some U.S. Treasuries, some corporate bonds, some TIPS, which have an inflation protection component to them. Adjust for inflation, your yield. So a little bit of complexity in the bond portfolio, but not too bad. And expected return, yeah, this is correct. 3 to 4% is right where short-term and 10-year bonds are trading today. And then 10%, they're recommending should be in short-term bonds. So this presumably would be at the 3% range, like a 1-month treasury or maybe up to a year or two, in short-term bonds that are basically cash, right? You can trade them. They're very liquid. You can use this sleeve to fund any surprises or your ongoing expenses, of course. And then they have a 5%, a little sweetener here for alternatives, which would only be $250K on a $5 million portfolio. And this is to add a little bit of diversification, AI thinks, to your to this portfolio. Okay, and then they're recommending that Mike transition his portfolio at age 60 to a little bit more fixed income, just to make that portfolio a little less risky on the margin because he's no longer earning a salary. So the conventional wisdom is to take risk off as you retire. I think you're adding some risk that you're not keeping up with inflation and you're not generating enough returns to maintain your lifestyle. And then here AI was warning that reality check, Mike, this is a fairly high number. 240,000 on 5 million is close to 5%. Conventional wisdom is more like 4%, that you could sell your stocks every year and still maintain at least your principal balance through retirement for as long as you need it. At least that's how the math goes. Once again, the returns have to come in the right sequence for that to happen. Historically, that's how it works. And I think AI is really making this point because the reality is that at close to 5%, even if he did 4%, he still needs things to go his way, which is surprising given how wealthy this person is. But really, his lifestyle has kept up with his wealth. The family spends a fair amount of money. And so this will be an issue if he's not hitting 7% plus returns. And the problem is JP Morgan's projections for 2026 are calling for a 6.4% return over the next 10 to 15 years. Now, obviously, they don't know for sure, but they're factoring in current valuations of the stock market where bonds are trading at in order to do these complex forecasts out into the future. Maybe they're too conservative. Maybe it's going to be more like 7%, which is around the average of where it's been for the last couple of decades for a 60-40 portfolio. 7%, yeah, that would work out for Mike in this scenario, but he's still leaving his portfolio, his retirement, which is very important, to a bit of chance. He's going to have to stay disciplined in selling that amount of money, even if the market's down, to fund his lifestyle, because there are a fair amount of scenarios where his principal, his $5 million, really declines over time, especially over 30 years, if the sequence of returns to get that 7% don't go his way, as we talked about the negative compounding. So the AI portfolio is basically a diversified public markets portfolio with a lot of bonds and just a little sleeve of alts in that 5% category range. Okay, but here's the issue with this portfolio. It's not very ambitious, number one. It may or may not meet his requirements for his yearly spend. Likely to, but it might not, which would be bad, right? You could have that negative compounding issue we talked about, and you're watching your principal just decline each year, which does not feel great, especially when you don't have an active income to help offset down years in the market. There's not a lot of tax loss opportunities in this portfolio. It's a couple of ETFs. And so when he sells some of those shares of those ETFs, he's got to pay capital gains, full freight on those distributions. So this is a very conservative, very basic vanilla portfolio that I think is too defensive given his goals and given who he is, an entrepreneur. He's comfortable with taking a bit more risk to achieve great outcomes. Obviously, we'd want to talk with Mike and verify that. Okay, so here's exactly what I would do differently with this portfolio. And so we're going to rebuild this from the ground up. For this type of client, for the majority of our clients, we tend to focus on income. High-flying AI stocks are great, but a technology-dominated portfolio like the S&P 500 tends to be difficult for most people to hold during downturns. So we want to create 3 buckets for our portfolios. Bucket 1, equities, stocks. Mike already is wealthy, so we don't need to try and beat the market. We don't need to try to beat the S&P 500. That would be nice, but it's not the main goal here. The main goal here is generating $240,000 and growing the portfolio over time. That's a win, because as AI alluded to here, the biggest risk of this portfolio is timing of his returns. Therefore, we want to remove that timing risk. We want to design his portfolio so he doesn't have to sell stocks in the down years to pay for basic expenses. It doesn't really matter what's happening in the down years based on how we're going to structure his portfolio. So this part of the portfolio is designed for long-term growth, but it's also going to generate some near-term dividends. We want to focus on dividend growth stocks. So the idea here is that this sleeve, this bucket, is going to compound his wealth over time and grow dividends along the way. The idea is that he's going to be able to use this side of his portfolio later in life to withdraw recurring dividends from as it continues to grow. So the nice thing about that is that he's generating cash flow via growing dividends from day one via a diversified portfolio of 25, 30 stocks. And that way he doesn't need to sell anything. It doesn't matter what the stock market is doing those first few years. He is collecting a stream of regular dividends that, if he or his advisor is chosen correctly, are going to grow over time. So these would probably be high quality, large cap, mostly US stocks, but perhaps several international stocks for worldwide exposure. And the general idea here is, even in the early years, those dividends are covering a base chunk of his just monthly expenses. And this does a couple things for the investor, right? It does something for Michael's psychology. In a down market, he's still thinking about the income as a paycheck that comes in only if he keeps ownership of his stocks, right? If he sold everything, that income is no longer going to come in. So this enables him to separate performance from income, which is exactly what we want for good investor behavior. It's all about how long you stay in the market, not timing the market. And so it's going to become less stressful than some people will sit there and watch their portfolio jump up and down because it's their only source of income in retirement. This enables the retiree to just stop worrying about it so much and go on with their life and enjoy their retirement. And so in my experience, it's a far easier investment plan for most people to stick with and not panic sell, because everybody likes getting recurring checks, while very few people like selling stocks, especially when their stocks are down in a particular year, if the market's having a down year. Most people like seeing their principal grow. They don't like selling their principal to live off of. Okay, bucket 2, private assets. These are income-focused investments in the private markets. Technically, these are called alternatives. And this is part of the portfolio that we want to try to drive alpha. In other words, outsized returns relative to a traditional 60-40 portfolio. We're not trying to drive alpha with his equity side of his portfolio that we just talked about. We're trying to grow dividends, checks to him over time, and compound that side of his portfolio. It's mostly geared towards growth in the future. This bucket, bucket 2, is focused on income today. Immediate income. And so it's designed to be more defensive in nature. This is defensive income that typically yields much higher rates than traditional bonds. A traditional allocation in this sleeve, in this bucket, might look like this. 30% of his portfolio in diversified debt investments, which can generate fairly high monthly income. And that rate could be double a traditional bond yield. And so that would be the bulk of this bucket, this 40% bucket that we're talking about. 30% in debt investments, income investments, and maybe 10% in private equity. That 10% can be customized for maximum total return potential, or we can also focus on income strategies within private equity for that 10%. All right, so that's 40% in bucket 2. And then in bucket 3, we think of this as insurance. This could be as simple as short-term bonds, which was about 40% of the AI recommended portfolio. Here, we have a much smaller allocation because we have defensive income coming from the debt investments, and we have some dividend investments coming from the stock side of the portfolio. Now, perhaps a younger investor wants to take more risk with this 10%. Maybe it's in something like gold, metals, or even something like Bitcoin. Right? I think of this sleeve, this bucket, as the insurance bucket. You're basically trying to insure your portfolio from some crazy event happening, whether that's in your day-to-day life, so you need access to cash, liquid cash flow, or we're talking about global currency debasement, right? Where gold and Bitcoin might be doing well relative to your portfolio, and it's a bit of a diversifier. But that's for you to decide. For simplicity, let's just assume Mike put all of his 10% in short-term bonds, which once again are in that 3.5% range today. All right, so what did we do here with this portfolio? Well, first, we took what was an extremely defensive and fairly, I would argue, mediocre AI portfolio. Granted, we could go back and forth with it and it would get more fine-tuned for Mike's needs. But the initial recommendation I don't think was appropriate for this investor profile because it relies on market timing a bit too much. And so with our revised portfolio, I think we've accomplished a few things here in an attempt to meet Mike's goals with this 3-bucket strategy. And those 2 first buckets being the most important. The second bucket is meant for income today to really bridge the gap on his expenses, and then letting the first bucket do its thing, leaving it alone, letting it compound over time. That is the dividend growth engine that is going to be paying him the bulk of his dividends in his later years. The further we go out into his retirement, the higher those monthly payments should get from those recurring dividends that are coming from the growth side of his portfolio. Yes, it's going to start at anywhere from 1.5%, maybe 2% in those early years based on today's stock valuations for these type of quality dividend growers. If he invested in great companies, those dividends should increase over time. And therefore, we have a nice balance of both income and growth upside in order to meet both his near-term and long-term cash flow needs. And if this portfolio goes to plan, Mike's not going to be forced to sell any stocks in those early years if they are negative in order to fund his basic monthly bills. He can just collect the income and he can let his principal compound over time and do its magic. All right, so here's why this matters. Because most generic portfolios look fine on a spreadsheet. They look fine in AI. But in real life, they can break because volatility plus withdrawals, selling your stock to fund your lifestyle, plus taxes, that's not a great combo. it requires things to go fairly well. It requires things to go smoothly in those early retirement years, but nobody knows the sequence of returns. Nobody knows how things are going to go those early years. All right, so how could you implement a portfolio like this? Okay, step one, you decide your income needs. Get really laser focused on what are your ongoing expenses for your lifestyle? What are you going to need in retirement? What are you going to need on a month-to-month basis? Build this growth sleeve that is designed to compound and be the growth engine of the future. And it's allowed to be volatile, so it can compound for years without you touching it. Maybe put some simple rules around rebalancing that portfolio so no individual positions get out of whack. I mean, basically, at the end of the day, it's pretty simple. Just make sure that you're not asking $1 to do two jobs. You want one sleeve, one bucket of capital to be focused on long-term growth, and the other one to be focused on short-term immediate income needs. All right, point two, with that second bucket, make sure you are looking at alternative investments like real estate debt, things that generate defensive income that tends to work across market cycles, that is tied to contractual cash flows that are not dependent on whether or not the stock market is going up or not. And in this part of your portfolio, you want to think like a lender, not a stock picker, of course. Because if you do this, it's a bit of a cheat code when you can combine cash flow plus risk control. It's kind of a cheat code to funding your lifestyle indefinitely. We call this evergreen income. This is always the goal of any portfolio that we put together because it has the potential to generate growing monthly distributions for you and your family for the foreseeable future, as long as you might need it without having to sell down the principal. And so hopefully you can watch your principal grow over time as you still collect that income on a recurring basis. That way you don't need to worry about the Fed keeping interest rates a little bit higher so you can meet your bond income needs. You don't have to worry about whether or not we're going to have another bout of giant inflation, and therefore your bond payments are not going to keep up with the cost of living. Your debt sleeve is going to have some variability in it, some protection with floating rate components to protect you from inflation. And so the question you might be asking yourself is, why don't more advisors recommend this strategy? Typically don't recommend this type of plan because it's not as easy for them to implement it and rinse and repeat it across large pools of clients with uncapped fees to them. Most large financial advisors, they want everybody to fit in their vanilla 60-40 model so they can give cookie cutter portfolios to as many people as possible. That lets them keep bringing in new clients, stick to the plan, which keeps their operating margins very high. But once again, JP Morgan is saying that we might only achieve a 6.4% return in a 60-40 portfolio for the next 10 to 15 years. So even if that portfolio strategy is closer to 7%, it still is not generating a lot of margin for error if you have similar lifestyle expenses as a percentage of your portfolio to good old Mike here, because that 7% is not going to guarantee a risk-free retirement. Not that our strategy necessarily will either, but I think a lot of people go into a 60-40 portfolio thinking that, oh, no, this is the guaranteed plan. This is the plan that is going to get me through to the end, which is not always the case. So the key is don't just diversify and sell your principal to pay for expenses each month. Maybe be a little more thoughtful about adding a higher income component, maybe even a dividend growth strategy with higher cash flow investments to potentially fund your lifestyle and your family's future without having to sell stocks and worry about the timing of market returns along the way. And so based on that portfolio, those three buckets, here's what Mike's portfolio might do over time. All right, so up here we have the three buckets, the growth engine of the portfolio, the stock bucket, 8% dividend growth each year. So we might only start off at maybe a 2% dividend yield based on today's valuations of this stock portfolio, but we would expect that portfolio dividend to grow over time. So in that first year, his $2.5 million, the 50% allocation of his total portfolio, might be generating $50K in dividends. But thankfully, dividends tend to grow if you invest with quality companies. And so he is all the way up to $168,000 by year 15. And keep in mind that this isn't meant to be his total income, right? This is meant to be the giant dividend provider later in his life. This is the growth part of his portfolio. What is meant to address his income needs short term is the real estate private equity bucket here, this income bucket that's going to be focused mostly on real estate debt and some asset debt that tends to generate higher income today. So on $2 million, 40% of his portfolio, that generates $160,000 right out of the gate. And with a little bit of appreciation in this bucket, 3% growth coming from partly the debt investments that are not being paid out current in distributions, but partly from the private equity sleeve in this bucket he's getting to $247,000 as a steady state on that $2 million over time. And the last column here is the bond bucket, that 10%, what I call the insurance bucket. That is generating a little bit of income ongoing. And the reason it's growing is because the portfolios are being rebalanced along the way. And so you get up to $20,000 on 1.2. And so the total value of the portfolio starts at 5. And because the portfolio is generating income and appreciation, the portfolio still grows over time. So he has a great big balance by year 30 in this scenario, with a very healthy amount of distributions per year that stems largely from this growth bucket, which is the dividends over time growing in his largest sleeve of his portfolio. And so this looks a lot better to a possible scenario where that $5 million starts to slowly bleed over time because he got unlucky with the sequence of returns that we talked about. If that sounds compelling and you want help implementing that portfolio, there are resources for you down below. Thanks for watching.